Okay, folks, welcome to our fundamental and technical analysis of Decker's Outdoor, symbol DECK. And what we're going to do is what we normally do. We speak the truth. We say it like we see it. We'll be talking about the company, some fun facts, earnings, financials, its investors' business ranking, its valuation, and of course, we'll be doing our technical analysis of Decker's using our automated trading software, TrendSpider. So with the technical analysis, we'll be including seasonality, meaning, are we at the point in time of the year where the shares outperform, or is this more of a lethargic time of year for the stock price? And I'm going to ask everyone before we get started, like, subscribe, you know the deal. And I encourage you to please leave a comment. I'll be more than happy to get back to you, whether you agree or disagree. So let's get to it. To begin our fun facts off, the origin of the company is not Australian. Many people are under the impression, due to the UGG brand, that this is an Australian company. It is not. It is the parent company of UGG boots. It is also the parent company of Hoka Athletic Impact, as well as Teva and its sandal business, which is Sanuk. And they were actually founded in Santa Barbara, California, about 50 years ago, and currently have about 3,000 employees. So in short, they went from a small California-based operation to a global brand. So last week, the company reported earnings, and as is typical for the operation, it just did outstanding. They beat on EPS by 28%, that's earnings per share. Revenue beat by 9%, and this is a consistent theme with the company. It beats on EPS, and what I love even more is that it beats on revenue. You can manipulate EPS. It's very difficult to manipulate revenue because revenue equals sales. Now, for this earnings period, it was the Hoka shoe sales that surged, driving Decker's Outdoors earnings and stock higher. This was published on October the 25th. Some key takeaways from the earnings report: soaring demand for Hoka brand shoes helped Decker's Outdoor post better than expected earnings and revenue for the second quarter, sending its stock higher on Friday. Hoka sales gained nearly 35% year over year. That's huge. That's outstanding. This is a retailer. And sales of Decker's UGGs brands were up 13%. And what I find really outstanding about this earnings report is that the company raised its full year revenue outlook. Now, for anybody that's listened to me for any length of time over the past few months, I have stated and restated that the consumer is dead. They have no more borrowing power. Their savings have been wiped out. Yet we have a company that's seeing demand. And unlike other consumer discretionary names like Starbucks last week, which reported as well, they suspended forward-looking guidance because they don't know what the new year brings. With Decker's does know what the new year brings. They have a good pulse check on the market, and they felt confident enough to raise their revenue outlook for the full year. The company reported second quarter fiscal 2025 diluted earnings per share of $1.59, with revenue up 20.1% from a year ago to $1.31 billion. Both exceeded estimates compiled by Visible Alpha. We already touched upon the Hoka and the UGG sales increase. To continue on with their brands, their Teva line, that was up 2.3% to $22 million. So that's a small piece of their business. Sales at Sanuk plunged. Oh, interesting. Sales at Sanuk plunged 47.6% to $2.8 million. And they were down 15.8% to $25.8 million for other brands, primarily Koolaburra. Now, being a technical, the share prices were up 10.5% on Friday post-earnings announcement. So what that leads me to believe is that the street is not concerned, nor is the company, with its raising of guidance moving forward with the declines in these other smaller lines of business. Moving on, domestic revenue rose 14.2% to $853.9 million and surged 33% to $457 million internationally. Direct-to-consumer sales added 19.9% to $397.7 million. So what this is telling us is that they're able to sell direct to the consumer, cutting out the middleman, thus impacting their margins. We'll take a look at those margins in a moment. Decker said it now anticipates full-year revenue growth of about 12% to $4.8 billion, up from its previous outlook of a 10% gain to $4.7 billion. So the only flies in the ointment here were the sales at Sanuk and the Kookaburra brands. Now, taking a look at the Investors Business Daily rankings for Deckers, it has a composite rating of 95. The highest it can go is 99. It is, of course, in the apparel and shoe-related manufacturing groups. Its EPS rating is a 99. Relative strength is 89. When we talk about relative strength, people think of the RSI. That is not what relative strength is referring to. What it's referring to is that Deckers is able to outperform 89% of the S&P 500. Now, while its group strength is only a C-, its accumulation distribution ranking is B, so the shares are under institutional accumulation. Its earnings per share last quarter up 39%, 3-year EPS growth of 33%, and an EPS estimate percentage change current year of 15%. Return on equity, 39.2. Folks, this speaks volumes as to the efficiency of management. If you have a ROE of mid to high teens, you're considered to be a respected management team, but an ROE near 40, well, you're a demigod. Sales change on a percentage basis versus the prior quarter, up 20%. 3-year sales growth rate, 17%. Debt, 0. You got to love that. Now, what I want to do is draw your attention to this other new fun fact, and that's the fact that the share price is up over 50% on the year. And when you take a look at this chart of Deckers relative to the S&P 500, you'll see that the S&P 500 is only up 23% on the year, which is very respectable. And this next chart, you'll see that since 2004, Deckers is up 2,000% relative to the S&P 500, which is up only 720%. So Deckers, a company that you never hear about on CNBC, is dramatically, or has dramatically over the past 20 years, outperformed the S&P 500. Now, moving on to a more detailed view of the companies. We already covered the PE multiple. It's in the 30 range, but I want to focus a bit more on gross margins. The gross margins are 56.5%. Net margins 18.3 with operating margins of 22.3. Me, I'm the type of guy that I need visuals to show what this means on a historical basis. So let's take a look at this chart here to better illustrate how impressive these numbers really are. And what I want you to focus on primarily, I'm a big believer in as goes revenue, so goes the company. And the revenue number is highlighted in blue. Quarter after quarter consistently has been rising ever since, on this report anyway, the March quarter of 2022. Add to that, gross profits have risen as well. Adding on to that, net income has risen as well. Now, you remember earlier, I mentioned that the direct-to-consumer sales, where they're able to cut out the middleman, that added 19.9%, almost 20% to their revenues. Now, by cutting out the middleman, how much do you think of that savings drop down to the bottom line? It's clear from the net margins that a good amount of the savings by cutting out the middleman or owning brick and mortar stores has allowed for net margins to expand quarter after quarter. Deckers' net income has surged 52% year on year and by 7% since the previous quarter. Deckers Outdoors operating income has increased 48% year on year and by 7% from the previous quarter. Deckers gross profit is up 34% year on year and 5% quarter on quarter. Deckers net margin, which is what we just spoke about, is up 26% year on year and by 3.4% since the previous quarter. This is truly impressive results. Now let's move on to valuation. Now, valuation is a very, very tricky topic. When you use Investors Business Daily, that's giving you a valuation of PE multiple of 30. This is giving you a valuation multiple of 31.9. Investors Business Daily doesn't really care what the valuation is. It's all about EPS and revenue growth. And I'm kind of in that camp. The however is that what I will do, as this chart is able to illustrate, is that the price to earnings ratio, or is that price to earnings on a historical basis going back to the March quarter of 2021 is extremely frothy. Decker's price to earnings PE is 45% higher than its 5-year quarterly average of 22, and it's 17% higher than its last 4 quarters at 27.2. Now, I was trading the markets back in the late 1990s, and I forget who said this, but it was just battered early on in the dot-com boom, saying that valuations don't matter. And he was right. For a good 3-4 years, he was absolutely right. Valuations didn't matter until one day they did. So I'm not going to allow this valuation, even with the price to book. Decker's price to book is 90% above its 5-year quarterly average of 6.5 and 28% above its 4-quarter average of 9.7. So getting back to my commentary with regard to valuation, while I do not allow valuation to really influence me if I see a strong company with solid management and a chart setup, which we're going to go to in a moment, that's looking really, really good, I am not going to allow the valuation to influence whether or not I'm bullish or bearish on a stock, because we know the pendulum swings to extremes. Stocks and the market's valuations in general can get swung to an extreme, and you could argue both the S&P 500 current multiple of around 37 and Decker's current multiple of just over 30 are frothy. So what does it influence? What it will influence is the size of our position. It will also influence how tight we will keep our stops, and that is how we protect ourselves falling victims of a stock that is expensive on a historical basis. No doubt about it, the stock is creme de la creme when it comes down to strong management, focused on their balance sheet with zero debt. They are simply executing on their strategy. So now let's move on over and talk about the technicals. What's the trade here? So to help us out here, we're going to be using TrendSpider, which is our multi-time frame automated technical analysis trading platform. And what we're going to do here is we are going to build out our hypothesis for which way Decker's is going to go. And what we like to always do is begin with a very, very high level view, giving us a 100,000 foot view of the battlefield, which is the stock market. Now you can see here on this monthly chart that we had put in new all-time highs in June and then backed off. And what we did is we fell back into a very, very orderly and tight consolidation, putting in support at around $136 per share. On the month so far, and it's really hard to divine how the month is going to close out. We don't have a crystal ball, but at this snapshot in time with a few trading days left to go in the remainder of the month, 4 days to be precise, at current we're seeing a breakout above an upper band of resistance on a monthly time frame. That is very, very attractive because we've already done our homework here, right? We know that we have sound management. We know that the shares are under accumulation by institutional investors. But we also know that the market and Decker's, they're both expensive on a historical basis. So while we're bullish, we're not children. We're professionals. And we're going to approach this trade from a very, very disciplined standpoint. Now, the first thing we want to do is focus on our risk. What is our risk? Well, to identify what our risk is, we need to know, do we have any overhead supply? And you may be saying, well, Bob, you call yourself a professional. If you were a professional, you would know that we're just off of all-time highs. You're looking at it right now. That's a fair point. But I also want to invoke the usage of one of our tools, and that is automated technical analysis with the click of a button here. So we know that, yes, we do have resistance up at around 180, let's call it 186 per share. We also know that that price point is now being extrapolated out and now having or forecasting an upper band of resistance moving forward. So even though we break through this upper band of resistance, We still have what technicians will perceive to be overhead supply, even though the share price has never been there before. You're trading against algorithms. You're trading against technicians. So understand what they're looking at, and this is what TrendSpider brings to the table. And if you're not currently using it, folks, I would strongly recommend that you do. I believe in it so much that I give it away free to our silver and gold level members. There's a link below. If you want a 35% discount code, use CON35. Again, CON35. Use that link below on YouTube, link above on Twitter, and get armed with this. Now I want to move on to a weekly chart. So we know that the monthly chart, at current we have a monthly breakout. What's the probability of that monthly chart holding the breakout? I would argue it looks pretty good. And the reason is that we actually broke out on a weekly time frame back on September the 30th. Then we did a retest of the breakout point and it held. We had a consolidation week. Traders knew earnings were coming up. They didn't want to buy. They didn't want to sell. They just sat, watched, and waited. The shares pulled back yet again to retest support. And then what you had was what we like to call follow through. You break out, you pull back, you do a retest of what was resistance, should now act as support, and then you get follow through. That is a major buy signal for the stock. But there's something else that's going on here that has me even more attracted to the stock moving forward. Let's take off all the automated trend lines and my drawings. And let's overlay on this weekly chart the Keltner channels and the Bollinger Bands. You could see here that the Bollinger Bands in red are now trading within the Keltner channels. Still pretty wide on a historical basis. The last time we saw this was back here in a year ago, October of 2023, when you had a Bollinger Band squeeze setting up and we fired off for a major bull run. Now, this in and of itself on a weekly basis does not excite me because, again, these are still pretty wide, nowhere near as narrow as it was back in November of 23. But when we do a deeper dive and now we drill down, not just from a monthly chart to a weekly chart, but from a weekly chart to a daily chart, things get all the more pretty. So here's the Bollinger Band squeeze that began here, October the 7th. The Bollinger Bands moved to within the Keltner channels, and as is typical, the institutions will blow out all the stops right before they rip it up higher, meaning the share price higher. Now, what I'd like to see here before executing on the trade is a pullback and a retest of support here at around 160 per share. And given the news over the weekend of Israeli attacks on Iran, the fact that we had some pretty bearish technical price action in the equity markets on Friday, we may see some follow-through weakness to the downside in the equity markets on Monday. If Deckers follow suit to the downside, I'd be eyeballing that 160 mark as an opportunity to begin bull operations. Now, what's the stop loss point? This is pretty easy. If we fail to hold, let's call it 158, let's give it a little bit of room. If we close down below, I don't mean trade intraday below 158. I mean if we close down below 158 per share by the end of business any day next week or the week thereafter, we are out. Why? The reason is that, remember, we know that the stock is very overvalued as well as the equity markets. We do not hope when we should fear. That's for children and amateurs. Now, where might the share price be heading? Let's go back to the weekly chart and let's talk about price targets. Let's overlay on the weekly chart that monthly resistance level shown earlier. Now, again, what I'm going to do is I'm going to use the algorithm to identify where our support and resistance levels are by a click of a button. And there you have it. So we spoke about this upper band of resistance already. So our initial price target on Deckers is initially here, to be fair, at around 185 per share. If we do break out and above that level, I think that we're heading up to around 195, 196 per share. And if by chance we happen to break out and close above this upper band of resistance, I think we could be heading up to a 200 handle on Deckers. I wouldn't want to forecast that out right now. It's getting in front of our skis a little bit. But right now, initial price target number one is at 185. Price target number 2 at around 196. I feel comfortable with saying that. But again, I will remind you that the markets are coming under a bit of pressure of late in terms of technicals. You saw the Dow Jones and the S&P 500 break weekly support levels, both on a cap-weighted and equal-weighted basis. And we do have headline risk going into the new trading week with the conflict over in the Middle East. So while we're very bullish on the individual company, my concern lies more with the rest of the market. So all things being equal, we are bullish on Deckers for the longer term, and we are rating it a buy. Folks, thanks for being here. If you enjoyed this video, please like, subscribe, you know the deal. And don't forget, join us 6 p.m. Eastern Standard Time on our live streams on Sunday for Sunday Night Futures Live. That's where we review the opening price action of the futures market going into the new trading week. A great group of folks there. We also go live on Thursday nights, same time, 6 p.m. Eastern Standard Time. And we also have a free forum. It's called Bull and Bear Banter chat, as well as my news feed that I put out. And that's free for now, but that's going to be closing down soon to free members. So act quickly. And of course, you'll have access to it if you're a member to The Contrarian Trader. Get our 14-day free trial offer. Use the link below on YouTube, link above on Twitter. And of course, you get TrendSpider included with your silver and gold level membership. Now, for those of you that were good enough to stick around through the end of this video, I want to leave off with seasonality. Seasonality, this is an included feature with all TrendSpider membership levels. And by the way, if you're not ready to join up to the Contrarian Trader, again, use that discount code below and get your subscription. Trend right now on a monthly time frame going back to 1993. The month of October, we finished up 52%, which is, okay, 50-50. Nothing really to brag about in terms of seasonality. But when you take a look at the month of November, which is generally the strongest month out of the year for the S&P 500, it's closed up 71% in the month of November and 58% in the month of December. But what gets more interesting is that when we drill down and go from 1993 to a 10-year view, you'll see that the landscape changes. And over the past 10 years, Deckers has been up 90% in the month of November. December becomes a coin flip. And on a weekly time frame, we are nearing or entering a very strong sequential period of time over the next several weeks. And I would say in the last couple of weeks of December, you may want to think about selling some covered calls or perhaps booking some profits. Have a profitable week. Be well.